If you put up a chart, and Federal Reserve actually publishes this data, there's a chart of the real Fed funds rate. So it's the Fed funds rate minus CPI. Since 2002 to 2022, it's been negative for most of that time. That is a very unusual phenomenon where there was no real cost of money. It was free. You would get paid to borrow. As a matter of fact, it went all the way to minus 8% in 2020. So you could just borrow money and buy anything and you would make money because those prices were rising at double digits and you were borrowing it for, almost 1 or 2%. Now that should never be the case. And we had a case of helicopter money in 2020. That's the reason why the inflation didn't stay on Wall Street. After the 2008 global financial crisis, a lot of the Fed credit went to bail out banks. So banks had bad assets, mortgage-backed securities. The bank received credit from the Federal Reserve. Federal Reserve took on these bad assets. The banks had credit, so they were solvent. They could keep their doors open. But the money supply never really boomed because the money wasn't lent out into the larger aggregate. It wasn't really going to making massive loans because the public had a lot of debt. The next time we have a recession, we're starting out with a $2 trillion deficit. The deficit is going to go between $4 and $6 trillion. So the next time the Fed tries to bail out the economy by returning to ZIRP and QE and whatever, that credit that goes into the banking system is going to have to be used to they have no choice. The primary dealers have to participate in auctions. So that money via the primary dealers as a conduit will go directly into treasury auctions, which is going to boom the money supply. The last two recessions, the deficit went up by 300%. If it happens again, we're going to have a $6 trillion deficit. So it happens automatically. The automatic stabilizers kick in. So the revenue dries up, unemployment rate skyrockets. You have unemployment insurance kicks in. These are called automatic stabilizers. They don't have to be voted on by anything. And then, of course, if you do get the unholy union of Treasury and the Fed together, Donald Trump did say that he could take on the job. He doesn't know why he needs the Federal Reserve. He should just set the interest rates. So, if you get a union between Bessent and whoever, and they have another form of helicopter money, you can get, once again, trillions and trillions of dollars. This is not my imagination. It already happened during COVID, right? The Fed monetized $4.5 or $5 trillion of the $6 trillion in spending and mortgage forbearances and all that other stuff that we did post-COVID. And then you're going to have inflation take off, not from a very low number, from a high number, and then keep on going, because what's the market going to think about our ability to ever get inflation under control or ever get our budget under control? I call it a death spiral. So people say, oh, the consumer's healthy and they don't have any debt and corporations have cash, blah, blah, blah. Corporate debt, business debt as a percentage of GDP is very close to an all-time record high. Household debt is down to around 75-76% of GDP, but it used to be like 50% of GDP, going back decades ago. So it's not like the individuals don't have any debt, but remember I told you they're already extremely burdened by inflation. So they don't have the cash flow to handle the debt that they have. The fact is the government has a massive problem with debt and deficits, and almost everybody acknowledges that's the case, Republican and Democrat. But I don't care. We can't tax GDP. Try to raise taxes, which can't pass Congress anyway, but you can't tax GDP. Go to 100%, you get zero GDP. Listen, it's debt as a percentage of revenue, which is about 740%. That is incredible to me. So we have an insolvent nation, and then the interest rates spike out of control. The Fed's printing money like mad to try to get them down, but they still rise regardless. And he says, is that really a problem? Yeah, it's a big problem, because what are the things that are priced towards the 10-year note? Well, first of all, we borrow a lot of money. Our interest on the debt is $1.2 trillion this year. So that's a big problem. But then mortgages are priced. Right now, mortgages in this country are around 7%. What happens if they go to double digits? Is that going to help the housing market, which is already tonight? You know what else is priced off of the benchmark treasury? Corporate debt, business debt, private credit, auto loans, student loans debt is all priced off the benchmark treasury. So that is going to be the catalyst for the next debacle. And when we have a crisis like that, where the Fed's actions don't ameliorate the problem, they actually exacerbate the problem, because creating inflation doesn't usually send people scurrying into the long end of the bond market, correct? You'll have the private sector shorting bonds like mad, which I will be doing for me and my clients. That's the real problem, because where's the help going to come from? Solutions have always been, we have a bear market, the stock market's down a little bit. Oh, we have a recession. This is the new epiphany. Alan Greenspan started in 87, but it really got way out of hand under Bernanke. The solution is to return interest rates or force them down to 0% and to print a tremendous amount of money and engage in some form of helicopter money. Is it viable that some other solution will be tried before that? And I don't see it. I mean, we just had our best chance. We have a Republican sweep of the presidency and both houses in Congress. What have they done to solve our debt and deficit problem? We have Doge for a while, right? Well, Musk left on good terms, but the good terms didn't last very long. I think they found $160 billion. We need $1 trillion of budget cuts this year just to get to that 3% deficit to GDP, which just ensures that the ratio stays the same. But we're not getting that. So we have no solution but to have a debt crisis. And then we'll make the final solution, which is we just have to renegotiate the debt. We have to explicitly default on the debt. But we'll try inflation like every other country on the planet has done. The best case scenario I can come up, this is not a new phenomenon. It's called a death spiral. Japan has done it. Zimbabwe's done it. Argentina's done it. The Hungarian pengo, the currency after World War II, has done it. The Weimar Germany after World War I. So there's not many examples. The best example, the best outcome is Japan. So that was they didn't have I think they will, but haven't yet had that spike in interest rates. But what they did have is GDP in dollar terms that has not risen since 1989. So if you look at Japanese GDP as measured in inflation adjusted terms, which is measured in dollar terms, has not risen since 1989. Now, can your stock market trade at 22 times earnings and 14% earnings growth when you'll have 34 years where GDP does nothing? No. So that's the best case scenario. And every other occurrence of a death spiral has led to Zimbabwe-like inflation. So I mean, we have things going for us. We still have the remnants of the world's reserve currency, so that'll help us out. So maybe we don't have 1,000% per month inflation. So maybe we have double digits a month percent inflation. That's any solace. I guess 2026 and the catalyst being that the firing of Jerome Powell could be a pretty good catalyst to get the debt markets in chaos once again. It's not something that never happens. The last time we had this was April 2nd. And it didn't take much. It was just Liberation Day tariffs that got people spooked out, because here's what happens. So Liberation Day tariffs take global trade down precipitously. And if you don't have our creditor nations recycling that surplus into treasuries, treasury prices drop, yields rise, that blows up some hedge funds, that highly leveraged trades. And all of a sudden, just because there's a seemingly uncorrelated event of imposing a duty or threatening to impose a duty, because they didn't take effect until April 9th. Just the threat froze the bond market, and it was seemingly a non-correlated event. I mean, you get a recession or you get inflation going again by this new Fed head, whoever he or she may be. But I just know the person they get will just be there to slash interest rates. Okay, so that's all we know. Nominal rates will crash, real interest rates will plunge, and that's all you need to know. Well, I'm watching right now, but you asked me when the recession is coming. I'm surprised at the quiescence in the bond market, the quiescence with credit spreads. So that's why I'm, net long equities. And usually, I would think that given the dangers extent, geopolitical dangers extent, the fact that the real estate market is on thin ice, the fact that the labor market is definitely starting to crack, I would expect that credit spreads would start to rise. So, people are buying treasuries, short-term treasuries for safety and selling junk bonds. That's when it causes the spread to rise. But it's been quiescent. It's been causing no panic, no pain. One of the tightest, they've been in a long time. So extremely tight credit spread. So that means that there's no imminent danger as of this moment. But listen, as Trump showed us, by the stroke of a pen, by a decree, by edict, he could change the whole construct very quickly. But I can rest assured you, if you're one of those target date funds, 60-40 portfolio, buy and holds, a death to us part, you're going to get run over. So much of this economy is priced off the benchmark treasury. The Fed, it's not even a theory. The Fed cut interest rates by 100 basis points in 2024. And long-term interest rates rose. They did not fall. So I don't know why that would be different if he started cutting rates by 200 basis points. And that could cause big problems for a corporate bond market, for student loan debt, for the mortgage market, for car loans, everything. You're not going to hear this kind of stuff on mainstream financial media. They don't talk about it. Everything I said here is a fact. It's true. Came from my heart. And I just want people to say, get with an active manager that has a robust model that will not leave you holding the bag during the next liquidity crisis, credit crisis, or recession. You will regret it. Your retirement depends on finding that lifeboat.